Hi, you're watching ET Now Spotlight and I'm Alex Matthew. Now, arguably the biggest highlight of this week was the announcement of the Zomato IPO, first of its kind by a homegrown internet startup here in India that's offering up stake to you, the retail investor. Now, like many of its peers that are also considering IPOs, this company is loss-making, but there's still a lot of excitement around it. We ask a few very important questions. How should these new age, extremely fast growing companies be valued? What factors should you bear in mind before you take the plunge and subscribe to these IPOs? And what do you need to bear in mind on an ongoing basis if you do invest in them? Let's start by setting the stage. 2021 is already being called the year of the Indian unicorn, with global investors piling into companies that made rapid strides during the pandemic. But 2021 will also mark the coming of age of India's millennial era startups. Amidst the frenetic action in the primary market on Dalal Street this month, the excitement about a couple of new age companies that are looking to raise funds is what stands out. Food delivery and restaurant discovery platform Zomato will kick things off on the 14th of July. Paytm, meanwhile, is expected to seek shareholder approval to increase the size of its IPO on the 12th of July, after which it is expected to file its draft red herring prospectus with the market regulator later this month. And these companies will seemingly open the floodgates for a number of new age companies to hit the bourses. The likes of Delivery, Grofers, Policybazaar, Lenskart, Nykaa, and even Flipkart are expected to make their way to the primary market over the course of this year and next. It's not just the familiarity of the names of the companies and their products that is drawing attention. Zomato and Paytm will be looking to pull in quite a lot of capital. Zomato is looking to raise around 9,375 crore rupees in its maiden issue. That makes it the second largest IPO in the last 4 years. At the upper end of the price band for the issue, the company would be valued at around $8.6 billion, a richer valuation than international peers Deliveroo in Europe and Grubhub in the US. Fintech platform Paytm is looking to increase the size of its IPO to over 19,000 crore rupees. The company was valued at $16 billion last, but this fundraise could take it past $24 billion. The valuations are bound to make some investors uncomfortable, particularly because these companies have been loss-making. And what's more, analysts will have to use different yardsticks to measure these new age companies, because their drivers will be different from traditional businesses. For one, many new age companies are focused not on profitability, but on customer acquisition and aggressive market share gains. S. Narain, the Chief Investment Officer at ICICI Prudential AMC, admits that despite the challenges involved in trying to measure these companies, they can't be ignored, particularly because of the immense growth potential they have.
I come from the contrarian special situation area, and therefore I find it sometimes difficult. But in my company, there are many people who are better equipped to look at internet and those kind of areas. So they find many of these companies very interesting to look at. And I think, many of these products we use as customers. So it's very interesting. Some of these companies, whether they'll make money or not, some of these companies will make money. So that's the challenge that we have to do much better work. It's a very interesting period because we are not used to dealing with companies which don't make earnings. So these are companies which don't currently make earnings, but they're going to make earnings and they have phenomenal business models over the next 3 to 5 years. It's a very interesting period.
The action begins next week, and investors betting on the long-term prospects of the brands they know and love will line up to grab a stake. One thing is sure, it's an exciting time to be an investor in India. Let's talk about Zomato a little bit more. The company is looking for a post-IPO valuation of $8.6 billion. That's nothing to scoff at. My colleague Nentara Rai caught up with the management, in fact the co-founder, and asked how they arrived at that valuation and also the prospects for the business going forward. And she began by asking, what the road to profitability would look like.
So Nandana, the way we look at this is that their existing businesses will mature over a period of time, and then you continue to make new investments into growth for the future. I think as Zomato, we're very, very keen to actually do both. And I think as a combination, we'll see where it gets to, but we're very clear that as that existing businesses scale and become more mature, they have to, of course, be better in unit economics. And we'll continue to use those investments to actually invest in growth in the future. I think it's a good place to be. If you're investing so much, then you have so much growth in front of you, and there's so much opportunity in front of you. And that's exciting. And we're so excited to actually build the food opportunity in India and be the front runners of that. And there's so much more on the food opportunity also that we have to do.
Yeah. So what else can it be in the food opportunity? Can you share that with us?
And then today also, we just don't do food delivery. We are a food ecosystem play. We allow users to interact with restaurants for whatever they need, whether it's food orders, whether it's going out for dining, whether it's reviews and ratings. Even for restaurants today, we just don't provide food orders to them. We provide diners to them. We also supply raw materials to them. So it's a food ecosystem that we're building, and that's why users and restaurants actually love working with Zomato, because it does more than just one thing. And we want to continue to actually build on top of that.
So how can you build it? You started off by literally Deepinder Goyal, the co-founder, photocopying and scanning restaurant menus and uploading them, to look where you are 13 years later. Going forward, what could be some of those new opportunities and growth avenues?
And then if you would have asked this question to us 2 years back, I couldn't have told you where we will land 2 years later. I think our journey, our space, what we're building is dynamic. I think we'll be very clear that what we have today, we have to do more in that and do well and keep doing well, and that'll be the focus.
There is nobody to compare Zomato with in India, because you're going to be the country's first consumer internet company, the first such unicorn that's listing. So I don't have a peer to talk to you about in India. But can you tell us a little bit about how you stacked up on these valuations? Were you aware of the global pecking order of food tech companies? You had quite a few successful IPOs. Look at Deliveroo. You have had in England, you had another one. Was that the way you went?
So the valuation is always based on the current business strength and the future business potential. That's the first principle logic, and I think that's how the banking community and the existing investors and new investors who are coming in have actually been able to arrive at that in terms of what seems to be the right value. And the good thing is, I think there are enough benchmarks out there that people have actually triangulated with and figured out how this to be done. But at the end, I would say it is just about what we think is the current strength of the business and what's the future potential of the business. That's what determines the valuation.
Not about when you could break even, this, that, and the other. There have been plenty of brokerage reports out there that are saying you'll break even in 2 to 3 years.
I think they know more than we do. So we know what we're doing right now. That's more important for us. And we'll see how it unfolds in the future.
So when you went out on these road shows and you spoke to investors, because Zomato is a brand, that must have really, really helped. But what was the exercise like? Because everybody would have had to change their lens of, here's an IPO, and I can't look at this IPO with the traditional lens of EBITDA and profit and all of that.
I think there is enough. Times are very different. I think you compare with Amazon, like a couple of years, like 20 years back. Times are very different now. There are enough examples out there where people have seen what it means to build a hyper-growth business like ours, and what it takes to build an opportunity like ours. So I think we've had very, very interesting conversations, whole host of people that we never spoke to earlier, but it's such great to have heard their perspective, discussed Zomato with them. I think there is enough and more education out there than we think it is.
And do you ever get intimidated by the fact that there could be many, many bigger companies, far more cash rich, that could also enter this? Because hyper-local delivery is hot. It may even turn out to be one of the biggest buzzwords of 2021. So everyone from a Jio to an Amazon is talking about it.
So Nandana, in this space as well, I think we worked hard to get where we are. We came from behind, and now we are leading the market, the food delivery market as such. I think we need to continue to execute better. And I think you can't forecast whether somebody would come in or not. I think even if somebody was to come in, I think you need to continue to execute better on multiple fronts every day to stay ahead of the game. There are some inherent benefits that we have as a model where we, as I said, we are more like a Ford ecosystem. So users find many more use cases on Zomato. It's like a super app for food than anything. Restaurants find a lot of things on Zomato rather than just food orders. We do diners, we do raw material for them. So I think there are inherent advantages we have in our model. By the way, this model is very unique even globally. You won't find a Zomato equivalent player building food ecosystem like we have. Having said that, we have to keep executing like we have to stay ahead of the game. And we are playing this for the longer term. We are building the opportunity for the longer term. It's not about winning every day. It is about staying in the game. I think that's very important.
Well, it's exciting times certainly to be an Indian investor, and the number of startups that are going to be hitting Dalal Street is going to be significant over the course of this year and next. But it's important to understand how to look at these companies, how to value them, and what the approach should be over the course not just of the next couple of years, but over the course of the next 5 years and possibly over the next decade. It gives me pleasure to introduce to you my first guest today. We've got Nimesh Kampani, who's president at Let's Venture, joining in. Thank you so much, Mr. Kampani, for taking the time. And I want to start by asking you, a lot of these new age digital first companies are hitting the bourses. Is going to be a major change for the Indian investor. What is the institutional perspective though? I know that a lot of retail investors are excited. How will the big investors approach these upcoming IPOs?
Thanks Alex, for having me on the show. And I think that's a good question. I think if you go to see what is also happening, right, today, if you see a lot of institutional investors, the long onlys, the hedge funds, as well as the sovereign funds, right, have already started taking position pre-IPO into a lot of these new age technology companies, right? So I think, of course, there can be a lot of reasons for that. Of course, India is a large market, and you can give all of those examples. But if you see the traditional companies that we have listed on the bourses, today would grow around 20% and in that range, right? But when you look at the new age companies, they are growing at around 50%. So everybody wants a slice of that pie. So I would see a lot of interest coming in from foreign institutional investors, some of the domestics as well. And I think that is what you will see as we go forward during this year.
Okay. Now, just to name a few, you have the likes of Zomato that is likely to hit the bourses. You have Paytm. You have later this year possibly the likes of Nykaa, the likes of Lenskart, a number of these new age companies. The big question though, Nimesh, is how do you value them? And this, I think, a lot of people are going to be struggling with. There's certainly a premium being attached to several of these being household names already. And retail interest, like I said, is going to be tremendous. But on an ongoing basis, how do you value them?
So this is a very interesting question. And I think we should look back to what the poster boy of tech startups, right, Amazon has done, right? If you just look at the history there, we listed it around 97 when it was a loss-making company. The first time it reported profit was after 10 years, right? And it actually, if you were to read about it, you will see that I think the reason why it did very well and the reason why it has turned profitable is multiple things that it did. It focused on getting new users, right? It focused on investing in new categories and it led to acquisitions and always was launching new products and services. So I think it goes back to the basics of any new age technology startup, which is user usage and monetize, right? I think that's the way I think one should look at it, right? Getting users is the most important part, right? That is what is building the base. And in getting them to use your product, because humans tend to be quite a lazy bunch, right? Innately, we are quite lazy. So once we get used to something, it's not going to be easy to move on to something else, right? And of course, once the usage is there, you see the people monetize that, right? And I think that's the philosophy with which all of these startups work, right? And that is what is something that one should keep in mind on what is happening on that front. So when you look at these IPOs, right, I think of course people will say the valuation is rich because In traditional IPOs or traditional companies, we are used to valuing them based on their earnings growth potential, and they're already mature companies in a way, right? They're already profitable and mature. But in this case, I think the focus should be on one of the two things, right? The focus should be on the growth of users, right? Because all of these companies are quite nascent, right? They are today largely in the urban centers in India, right? Yet to penetrate largely into the internets. So I think the focus on growth of users is important. And second is the path to profitability, right? And when you look at path to profitability, you'll go into unit economics, you'll go into customer acquisition costs. So I think a lot of benchmarks will change on how you look at these companies. So when I'm looking at any of these IPOs that are coming, I would want to see what is the use of funds. Right? Is it an investment into new technology or a new product or service or a customer acquisition, or am I just giving exit to Ps and VCs who are entered early? Right? I think so. That is something that I would keep as my benchmark when I'm looking at these, because if you look at the growth opportunity in India is tremendous, right? But it's just that how we are going to use this money. So I think I'll keep my eye on what is the growth plans, right? How is the investments going to unravel as it goes forward, and ultimately profitability will come. But I think patience is the key. I think the investors will have to look at it with a long-term lens, because you might have short-term blips because of the way the markets behave. But I think ultimately in the long term, it will create value.
Absolutely. The path to profitability is very key there from what I take from what you have said. But just to play devil's advocate here, Nimesh, unlike the Amazon and when it listed, a lot of these companies are benefiting from that experience that people had with the likes of Amazon. You said is a poster boy of the startup world, and that certainly is the case. Quite a few of these companies are hitting Dalal Street with trumpets and fanfare. So one would argue on the other side that they're already valued at a very rich premium. What are investors getting when they're getting in at this stage, Nimesh? Is there enough on the table?
So I think that is where your patience comes to play, right? Something might look expensive today, but of course, when you're looking at quality, when you're looking at business with moats, right, there would definitely be price attached to it, right? Today, even if you look at the listed stock, if you look at the large listed FMCGs or the large banks, all have rich valuations, and they've been having rich valuations for the last 2-3 decades. It's not that it's just something that has happened. So I think when you are looking at businesses with moats, businesses with huge market share and huge potential for growth, I think they'll always be richly priced. And as I said, the key in this will be the patience, right? You'll have to hold on to it for a longer term. And the long term here, I mean, is not the 1 year long term that we typically use in the Indian parlance. Typically, I think you should look at it with a 5-year perspective, right? And as I said, the use of funds is very important, right? Whether it's
I was actually...
Yeah, sorry.
I was actually coming to that. In that, traditionally you would look at a 1 year forward multiple or a 2 year forward multiple, and you would look at trying to value the company as it stands right now. But like you said, first of all, some of these companies are growing at 50%. At what multiple and what value or what valuation metric would you use at this juncture to value these companies? Just a follow-up to the question that I asked you earlier.
So Alex, when you're looking at, say, a B2C company, right, I think it will no more be about earnings, because earnings aren't there, right? Revenue multiple is a thumb rule that people would apply. But I think what is more important is to look at unit economics, right? And just the case of Zomato, right? Zomato unit economics was a $30 loss on each delivery that they were making a year back. Today they are turning profit, because of multiple of factors, right? The usage has increased, the order size has increased. So I think all of those things will come to play, right? You need to look at unit economics. You need to look at what is the lifetime value of the customer, because what you are betting on is the growth in customers, right? What you're betting on is the customer retention rate. So a lot of these metrics that people look at will have to change, right? And you'll have to put a different lens when you're evaluating these companies.
Absolutely. And, certainly going to be a cause for a lot of us to maybe look at these companies differently, to study these companies differently. It's been an absolute pleasure, Mr. Kampani. Thank you so much for taking the time and for putting this in perspective ahead of some of these mega IPOs.
Thank you, Alex. It was nice to be here.
Alright, so that gives us a sense of how to look at these new age companies. We're clearly going to have to gear for a shift in the lens, as Mr. Kampani put it. But another factor to consider is the implications on the rest of the market. Let's put it this way. If you toss a small stone into a lake, you'll see a few ripples. But if you throw a big boulder into the lake, you're sure to see a splash. So what is the implication of these mega IPOs on the rest of the market? My colleague Jayesh Khilani has this report.
We have seen in past instances that whenever a large IPO is announced or opens up, there has been a liquidity rush out of the secondary markets in order to subscribe to the primary issue. As you can see from the screen, there are two instances where I really want to point out. One is Reliance Power and the other one being SBI Cards, both of them being more than $1 billion of issue size. And the Nifty, reacting negatively to these two. Of course, that also coincides with the global financial crisis of 2008 and the onset of the COVID-19 pandemic in 2020. That also played a part in these two. However, the Nifty did manage to decline about more than 20% in the month prior to their listing. And some of the other instances, NHPC, when it had been announced, SBI Life along with Tata Consultancy Services also declined about 1% odd. So the essence of this is that whenever large IPO is announced, there is an outflow from the secondary markets in order to subscribe to the primary issue. However, this time around, Zomato, where it will actually be placed according to the DRHP, the pricing that it has, put out, it will be in the range of about $8.5 to $9.5 billion. And there are some key names that I want to highlight, which are, quoting in similar market cap range. So you have Ambuja Cements along with L&T Infotech. From the FMCG pack, you have Tata Consumer along with Marico. InfoEdge, which is the other internet-based company that is listed in India, that also commands a market cap of more than $9 billion. And, it has surged about 33 to 34% in this year itself. Some of the other names are, Gale India, Aditya Birla Fashion, along with Cadila Healthcare and Havells India, that make it into this market cap bracket.
Well, beyond a doubt, it is clear that the times are changing. The Zomato IPO and the Paytm IPO that will soon follow could well prove to be a blueprint for several other companies, new age companies, to follow suit. Investors will soon have some more idea as to how to deal with these companies, and the complexion of the market as a whole could be changing as well. This was ET Now's Spotlight. Thank you so much for watching. Do stay tuned for a lot more.